My name is Chuck Whitman, and I build great traders that lead great lives. Traders I've trained have generated in excess of $1 billion in trading revenue and are found at some of the largest trading firms and hedge funds in the United States. Today, we're going to talk about the secret to big winning trades. The secret to creating big winning trades is to actually understand how a price bar forms. Once we understand the logic of how a price bar forms, then we can look at there and see there is a linkage between the price bar formation across different time frames. This is based on logic. This logic holds across every time frame and every market. It is ultimately fractal. People wonder, what's the secret to creating really big winning trades? We call them jackpots. A jackpot is a big winning trade. It's where you get a big pool of money in one shot. And one of the things we say is jackpots solve our problems. Most of the trading industry tells you to strive for higher win percentages. That's an illusion. It doesn't work. What works is having big winning trades. And how do we create big winning trades? By understanding how a price bar forms. See, the truth is there is no magical indicator, regardless of what anybody says. The secret lies in understanding the linkage between multiple time frames and recognizing how each time frame influences each other. The key is simple. We enter on a short-term trade where the risk is smaller, and then we ride that move as it unfolds in the context of a larger time frame trend. That's it. Enter on a low time frame with a small risk, roll it to a higher time frame, and ride it. By leveraging this understanding, traders can capture moves on higher time frames that take small initial risks, unlocking the potential for exponential gains. So why does this matter? Now, I want you to think about this for a moment. If you knew the low was in for 2025, what would that be worth to you? Well, it would mean that you could have confidence getting long, knowing that the price could not go below the low of this year. Give you confidence knowing that the market is likely going higher the rest of the year. And that would be a trade that then you could ride, not for 5 minutes or for 5 hours or for 5 days, but for 5 months or longer. And that's where the really big wins come in. That's where the high payoff comes in. You don't have to spend a lot of time once you get these trades going. You just let them unfold. With January in the books, we need to start looking at the formation of the yearly price bar. So January often provides clues as to what might unfold next. Does the high or the low of the year go in first? Well, January gives us a frame, and then we can analyze February in context of January. If February is able to break out higher, well, then we're starting to ask ourselves the question, is the January low the low for the year? Can we see the price action confirm this move? So, for example, in a yearly uptrend, we would expect the low for the year to go in first, and we would look at the January initial range. If we're able to take out January's highs in February, it suggests the low for the year might already be in. This would be a major insight for catching a significant move. I'll just show you 2 examples really quickly that are potential examples of this. One is Netflix. Netflix has been on this huge rally since 2022. Well, here's the January range, and we've already decisively through the January high in February. So was this pullback in January, was this the low of 2025? Well, right now, there's a story that's unfolding that, yes, this could be the case. Another position that we're long that we really like is gold. Well, gold here's the January low, here's the January range, which coincided with the highs back in October, and we've decisively taken out the October and January highs. So this is telling me that the low is probably in for 2025 in gold, and we're going to have an up year in gold. Very simple. So if we could get in here, go back and look at last year, right? So here's early in the year. If we could got on in here and ride this could have been a great trade. It was a great trade. So our goal is to ride a major trend while managing our risks smartly. So imagine if you could catch the yearly range with only a daily average true range of risk. So for example, at the end of 2022, the daily ATR for Bitcoin was $450 per day. If you risked one daily ATR on entry and caught the full 2023 move, Bitcoin surged $26,000 in 2023. This would be a 57R trade. You made 57 times your risk. So now let's take a step back and let's break down the fundamental mechanics of price bars so we truly understand how to apply this. So first of all, we want to understand the logic of price bar formation. Second, we want to understand the influence of higher time frames on lower time frames. And third, we want to understand how highs and lows form on lower time frames first, and then follow through to higher time frames. So a couple definitions. What is a bar? A bar refers to a period of a defined length. It's used in two key contexts. The first is how we define the length of a candle or a period. So we say the formation of the daily bar, it means the formation of the daily candle. Secondly, we want to define the interval in which a candle forms. So on a chart with base candles, a daily interval is often referred to as a daily bar. So what's the logic? Every bar has a high and has a low. When the low is formed, the only direction that remains for the bar is to go up. If the high is formed first, the only direction that remains is for the bar to go down. Let's talk about how price bars form in different market conditions. If a market moves lower at the start of a bar, it often does so to make its low for the period. Then it reverses and moves higher. When a market starts to move higher early in the bar, it often does so to put its high in for the period, and then it reverses and moves lower. That's the formation of a price bar. Now let's talk about higher time frame influence. If we accept the logic of how a price bar forms, then we can introduce another principle, and that is that higher time frames influence lower time frames direction. So if the monthly low is formed, then the weekly and daily bars must go up because monthly direction is up. They can go down a little, but they can't go down a lot because the monthly is going higher. If the monthly high goes in first, then weekly and daily direction will be down because monthly direction is down. Now they could go up a little, but the monthly is going to assert itself and push the bar down. Now let's apply this to uptrends and downtrends. Uptrends, lows form first. We want to monitor early in the period for the formation of the period low. Once the low is in, we roll down in time frames and we go find lower time frames to get long. Example, if the monthly low is confirmed, we'll trade weekly and daily buys as the monthly bar unfolds. Here's an example of one of the top trades from 2024 in Bitcoin. We want to notice that the low for the year went in on January 23rd. So early in January, the market sold off early. The low for the year went in on January 23rd of 2024, and then price was up the rest of the year. The high for the year was on December 17th. So you can see in here, the market never really traced very much. It rallied, it went in a long-term range, and it rallied again. Now let's look at a downtrend. A downtrend is the highs form first. So we monitor early in the period for the formation of a period high. Once the high is in, we roll down to lower time frames and we trade short. So for example, if the monthly high is in, then we want to be looking to be short on weekly and daily sells as the monthly bar moves lower. So here's an example in sugar. And one of the things we can see is in this downtrend, look at when the highs are going in. High for January, January 3rd, high for February, February 6th, high for March, March 2nd, high for April, April 2nd. Then we do get one counter trend where we get an up May, but the high goes in on May 31st so that the high June can go in on June 1st, and down we go. And then the high for July goes in on July 2nd. Here we just see how the highs and lows, once the low is in, the market moves higher, and once the high is in, the market moves lower. So why does this matter for this year? Well, now that we've established this core logic, we can apply it to major market trends for 2025. February is often a critical month because it sets the tone for the entire year. So understanding price action within the context of the January range allows us to spot major opportunities early. This is something, here is Solana, for example. Solana had a big up year last year, but we got some very strong negative price action right out of the box in January, and Solana has been moving lower, as well as Ethereum. So there's a lot of people that are bullish Solana, a lot of people are bullish Ethereum, but right now the chart is actually saying that the high is likely in first. That would affect the way we manage our trades. This bears watching. So the takeaways are the biggest winners come from riding higher time frame trends while managing risk on low time frames initially. By catching the yearly range on a small ATR risk, we position ourselves to get our jackpot trades. The key is understanding how price bars form and how higher time frames drive lower time frames. This is a logic principle that you can use over and over and over again. Because after all, what day is it? That's right, it's Tuesday. It's not just any Tuesday, it's Trader Tip Tuesday. And you know what Trader Tip Tuesday is? It is the Tuesday I come to you with tips like how price bars form. That helps you take your performance to an elite level. I'll see you next week.